All right, everyone. Yeah, there might be a few more people trickling in, but I wanted to get started regardless. So my name's Troy Belay. I'm the lead investor relations here at Tech Wildcatters, and I wanted to take a minute to share what Tech Wildcatters is. Most of you have probably heard of us, hence why you're on the call, but we're a global accelerator program and a venture capital fund strategically headquartered in Dallas, Texas. For the last 10 years, we have invested in over 100 early stage tech companies with a global deal flow. We select top tier founders for our milestone based program. This program helps the founders use outside capital only to scale while aligning them with the industry experts needed and a clear path to funding. I'm really happy to share with you guys Ricky Tejapayabal. Um, he has 20 years of investment experience. He's an entrepreneur, a startup mentor. He's worked in management consulting as well, investment banking, corporate finance for companies in the Fortune 500, including General Motors as it emerged from bankruptcy. So he is now the partner and CEO of Tech Wildcatters. And we are lucky to have Abe Minkara with us as well today. He is the Chief Investment Officer and founding partner of Legacy Knight Multifamily Office. Prior to Legacy Knight, Abe helped manage the portfolio of investments at Mark Cuban companies with a focus on technology, logistics, consumer product goods, and even helping with Shark Tank. So Abe is also actively engaged as an advisor and board member with a number of companies, leveraging his expertise in strategy, ops, and capital allocation to help accelerate their growth. Um, he is recognized as one of the 500 most influential business leaders in North Texas for 2020. Additionally, Abe is a member of Young Presidents Organization, North Texas chapter, advisory board member at Institute of Excellence in Corporate Governance, and many other organizations. So I really am happy to introduce them both, and I'm really happy to see what they're going to discuss today, like why is tech important? So go ahead, Ricky, take it.
Yes, thank you, Troy. Thank you, Abe, for joining us. So here at Tech Wildcats, we try to provide investor resources to just share out there the knowledge of why they should be looking at investing in early stage technology. And one of the segments that we're focusing on is the family office sector, because there's a lot of family office wealth here in Texas and also all across the country and even internationally as well. And there's no denying that the technology sector is a sector that's been driving growth in the markets over the last several years. And there was a study out there saying that the S&P 500 had carried from 2000 to 3000 was driven mainly by a lot of the tech companies. So there's opportunities out there, and the sector is projected to be another sector that's going to be strong over into this decade. But from family offices, many of them have already invested in tech, while some of them, if tech wasn't their core business, they're looking to learn more. So that's why we want to invite an expert, and Abe's the best in the business that have been worked with Mark Cuban for so many years. So from a family office perspective, and also now managing money for multiple families, that how do family offices look to, and how do we get them started into investing in tech? So I'm just going to kick it off with a couple questions that I've prepared. So first, though, why do you think the technology sector is the sector to shape the next generation?
Question, Ricky, and thanks for having me. I think because technology is impacting every industry right now. So everything needs technology to evolve, and it's moving fast. So if you are, as a business, are not already implementing new technologies to evolve, you're going to be missing out. And sometimes it takes an incident like a huge kind of, you want to call it a black swan event like COVID. Some people are calling it a white swan, but whatever it is, it really puts a focus on technology even more. And if you're not already prepared, you're going to be impacted. And it's also, I mean, as you've heard people say, COVID was kind of an accelerant to what was already in the process of happening. So if you were not prepared, or your trajectory was not in the direction of using technology to connect with your consumers, you were impacted significantly. And a lot of companies started using technology to really manage and become resilient during the shutdown. I mean, look at restaurants and how the resilient ones were using technology just to engage with their clients, either having the menu and delivery features on an app, engaging with them when you arrived at the location for them to to pick up your order. In some areas, there's even I think in Washington State, where you can via an app. Actually it's a local company called Headstorm that created an app where you can reserve a parking spot in front of the restaurant in the city, so that you can once you book for your order in a busy street, you have a spot where you can just park, pick up your order, and get on your way. So, and those are technologies right now that we are seeing that are solving problems, but are going to be existing moving forward as part of the business model on how to just engage and scale and connect with additional customers, not just your existing customers. But we see it across the board, and I think technology is going to be impacting, I mean, many sectors. I mean, healthcare, I think, is going to be another one that we're going to see significant advances in technology that will create and reshape the way healthcare, the whole infrastructure is set up right now. If you want to talk crypto and fintech, I mean, that's another emerging tech that's gaining a lot of ground now. And it did show a lot of resilience during COVID and kind of the worst period of COVID. Well, hopefully we've been through the worst and there is no second wave, but we'll see. But even EdTech, we've seen that big shift on how do we solve that problem when kids and students can't go to school. So different platforms have been emerging, video like what we're doing now. So all this is technology, and all this is either replacing or improving business transactions in how we interact with each other prior to COVID. E-commerce, marketplaces, what else? I mean, you have prop tech, ag tech, and cybersecurity. All of these different technologies, I think, are becoming even more important, having gone through this really tough period of COVID, and they're all becoming even more relevant now. You talked about cybersecurity prior to COVID. I mean, very well understandable. Every organization already at a board level needed cybersecurity experts. They needed to have a strategy. Now it's even more important. When everyone's working remotely, how do you make sure that your employees are following certain security measures to actually shield the organization from outside threats? Now you have your endpoints are multiplied by having remote employees work from home. So it's just the complexities were definitely amplified, but it really brought a lot of the issues that we really thought were important, but never really prioritized. And now we're just looking at, okay, now we really have to work on those, all of our initiatives, and really start investing and more time and resources on technology, because let's say we survived this phase, hopefully. There's a lot of companies that suffered and didn't make it. But if this happens again, and this will happen again, I think we're definitely going to be more prepared. But if we don't take the steps necessary to improve our current businesses using the technologies and really take lessons from what happened and make sure that we as business are going to be more resilient for another wave, either a second COVID wave, but who knows, 2021, 2022, another version of a COVID might hit. If as a business we're not prepared, we won't be able to make it the second time around.
Yes, thank you for the insight. I couldn't agree more that every time, whenever there's a change in the world, technology is what drives, whether it be new businesses or whether it be helping old businesses adapt and still be relevant or be even stronger going to the future, because there's levels of efficiency, there's new customers that they can reach to, and a lot of things that will factor in, because there's when you think about technology, it could be deep tech or it could be sometimes simple interfaces or something that will make people save time, do things more accurately, more correctly in data science. And it can just go on and on about areas about technology that you can think about.
Absolutely, yeah. And I was just talking at a broad level. I mean, deep tech is I think that's kind of the underlying power that will continually evolve and push to the surface. But there's some basic technology systems that still need to be implemented. But yeah, the deep tech, the AI, ML aspect that will be continuously improving and providing just more connections for us, and just empowering future automation as well.
Yes, there's the deep tech, and then there's the tech adjacent ones that just broadens the tech umbrella. So if you look at investing in technology, especially early stage companies, not only the business plan tech itself, but the founder is also a very big component on who do you want to invest in. So what do investors look for? How should investors be looking for? What's the methods that you recommend in selecting the right founders and the companies that they want to invest in?
So it depends. I think everyone's looking for, you know, you heard the old saying that you invest in the jockey and not the horse, and it's so true, especially at the early stage, Series A. It's all about the founding team, and because what you're betting is on as great of a business model, product, service the founding team has at that early stage. The investor is betting on their ability to execute on that strategy, their ability on building the product, their ability on taking that product or prototype to market. So, because you can bet on the product, but if the team does not have that skill set, it'll never really take off, and it'll just be a startup that was great and fun and you know, made it through all its cash, but never made it to the next step. And those entrepreneurs also have to be great salespeople as well. So they have to be resilient. They have to have that expertise in the specific sector that they're in. And sometimes you have a multiple founding team of co-founders that can complement each other on expertise. But you really need to have a driving force where the entrepreneurs are selling the vision, but at the same time, they are selling their abilities to execute on the plan to make that vision happen. And that's where the big disconnect is you have a lot of visionaries, but either them or their co-founders don't have really the experience or what it takes to execute on that plan and get the company to a point where, and because there's going to be a lot of pivoting and fine tuning at that early stage. So another feature you're looking for is someone who's willing to listen. And the fortunate founders are the ones who surround themselves with the right advisors and the right investors early on, because they can guide them. And so you need to listen to their advice. There should always be a conversation. There should always be transparency, and move that initiative as a team as much as possible. So the more open you are and less disconnected from your team and your advisors and your investors, the better chances you have on overcoming those difficult challenges, because it's not easy. Starting a business is not easy. But if you have a plan, you have the expertise, you have the right financial partners, you can start hitting those milestones one by one. So that's really, it's about the founder's ability to sell on their vision, the product service, and their ability to execute.
Yes, those are good insights. And I second on the part that how do you surround yourself with the right experts, the right mentors to help you? Because I believe that you're an entrepreneur, you're the expert in what you do, but none of us are experts in everything. So how do you increase your probability of success by not having to make all the mistakes firsthand? If you can have advisors, have mentors, trusted people that will help you. But also if you have 10 different mentors, you probably get 8 different advice. So at the end of the day, you have to make the decision what's best for you, what's best for your company. That's what the investors rely on, is they're betting on you to make the model work. So what are the expectations going in terms of whether it be the investment horizon, how long should they be expected to wait until they get a return? And also, do they need to be hands-on in terms of operations, or do they just invest and wait and see, just like they invest in the stock market, or is it more like their business that they have to also be actively involved?
It depends. So the majority of family offices are not VC, they don't function as VCs. So VCs are expected to be very hands-on, right? You're investing in early stage Series A, and you have a kind of an expectation to be an expert based on the sector and kind of the theme that you invest in. And you're expected to have a network as well to add value to your investments and entrepreneurs. And so the expectation there is to be very hands-on. On the family office side, and there are a few exceptions, but in general, the family offices don't have the bandwidth or the team internally to manage a number of portfolio companies at the same time. And what you would see is it's going to be less likely that family offices, the more traditional family office, to invest in early stage. Now, there will be some opportunities where you invest at an early stage, but in general, there's more of a likelihood for a family office to invest at a growth stage. So I would say maybe at a Series B plus, where a lot of the challenges at a seed stage have been overcome. The product or the MVP has already been clearly defined, a monetization strategies in place. The team has evolved where you have some of the key members already on board. You already have a paying customer or a number of paying customers. And you have kind of what you're doing is you've created your strategy for the next phase of growth, and you need a strategic partner to help you fund execution on that, versus helping you really define what the business model and the product and overcome that stage. That's more of where the family offices are going to play in general. Like, there will be exceptions where family offices have an interest in investing more at a seed stage. Now, you're going to capture a lot more of the upside the earlier you go, obviously, but you have to, the appetite for risk at that level is usually left for the VCs. And I think that this is kind of another question we're going to talk about, but the tendency is, and this is what we do, is we love early stage, but because of bandwidth limitations and we can't really manage a huge number of portfolio companies at that level because it's so hands-on, we would invest in early stage technology funds. So like a Tech Wildcatters, like a Sequoia and recent Horowitz Foundation, where they have that expertise, they have the network, they have the team, they have the resources to pick the best of the best. And so if the family office would invest in a top tier VC, capture the value at an early stage, and then typically with those VCs, you have an opportunity to co-invest at a growth stage. So either you co-invest and they have leadership funds or growth funds that you can invest in and co-invest with them at the Series B plus phase. So that's how you can capture both as a family office versus taking the risk of investing at an earlier stage. And typically the other reason is family offices, kind of the more established, bigger family offices, typically their check sizes are at a minimum of $1 million, and where for them to justify an investment, it's they want to make the bigger check because it takes the same amount of time to go through the diligence and process of just investing and managing a portfolio company that they're investing in directly. If they were to make a $1, $5, $10 million check, it's the same amount of effort as investing, let's say, $250 or $500 at a seed or a Series A stage company. So those are kind of the things that you think about and plan for under a family office structure.
Yes. So in terms of diversification, so should they also be investing in many different companies? And more importantly, should they be looking at something that correlates or has less correlation with their core family business in terms of diversification? Let's say COVID hits right now, their main business in hospitality, to invest in more hospitality startups, that all of that gets correlated, or sometimes it's a natural hedge that one sector becomes slow, the other sector may do better. And from a return perspective, you want to not be too tied up to one sector.
Yeah, a good question. So in general, you have to have diversification in your portfolio of assets. When it comes to the direct investment side, because you have to look at the broader scope. I guess the best way to explain it is look at the endowment model, where endowments that typically that have really performed well over the last decade or two have their allocation at a high level is in directs, in heavy on the alternatives, and also in the public markets. And so and the theme could be based on different asset classes. But back to your question on family offices, it's if the family office has an embedded business, if their strategy, if they invest in direct in companies at an early stage, then yes, it's going to be very, again, one of the main criteria is going to be synergies or alignment with their existing embedded business. I think the diversification would happen at a different level in the portfolio, but if we're talking about the early stage investments, then it will definitely be a criteria to invest within the same sector, because you're having diversification in a different aspect of your portfolio. Now you will see, because if you're going to diversify at that stage, you're almost creating a VC arm within the family office. And if that's what you're looking for, it's fine. But in general, you're more likely to invest at that stage in something that's more aligned with your core expertise and or embedded business within the family office.
Yes. So we have some questions in from the audience. First question, how many investments do you manage at one time, and how do you ensure that there's constant reporting and monitoring, that you have oversight, insight into those companies?
It's a great question. So it varies. So like we said, managing, let's say, 5 companies at a seed Series A stage is different than managing 5 companies at a Series B or C stage. The reporting is different. The expectations and the type of support as an investor, especially an investor who's hands-on, is different as well. So the number varies, but and over time, you learn how to just scale the support that you want to bring, and you kind of establish a little more structure on what your expectations are from the companies. I'll give you an example from what we did at the Q portfolio as we just the number of companies grew exponentially year after year. One of the things we did for the Shark Tank companies, which are very early stage in most cases, is we set expectations upfront on reporting. And typically the reporting, once we close a deal, the expectation was weekly updates and no exceptions. And over time, it evolves to a monthly update. And another thing we requested was financial reporting as well. And so monthly financial reporting and weekly updates. It might seem that it's a lot to ask from a lot of the entrepreneurs at that stage, and you see some resistance. But at the end, the entrepreneurs who get it really see the value in just having a time to reflect on what happened that week or what happened that month, being able to translate that into a clear communication to your investors on what what were the goals and achievements for the week, for the month, what were the challenges, because this way it gives you an opportunity to engage with your advisors and your investors on a regular basis. And because at that stage, right, and we're talking at early stage investing, right, the more you engage with your advisors and your investors, the more feedback you're going to get from them, and the more support they will be able to offer. And so communication, transparency is key, both in terms of just the business updates and the challenges and the financial updates. And so the last thing you want to do with a strategic investor is give them an update that's too late with a lot of surprises. So if there's a big challenge in let's say there is a major client challenge, a product challenge, or a cash flow challenge, the best thing to do is to reach out and say, I have a problem, need your help or advice. The worst thing you can do is wait and try to fix it, and then 3 months later, with no communication whatsoever, reach out and say, we tried to do this and this and this, and it didn't work, then we tried this, it didn't work, and now we're here asking for your help. Well, it's too late. And we could have had solutions for you, but now it's too late. You're out of cash. You lost your client. There's nothing we can do. And on the reporting side is also as important. It's not just important for the investor to see that, to get the transparency on the numbers, but it also shows that you as a founder, CEO, have that discipline and understanding of financial reporting, which is very important. And as an entrepreneur, at an early stage, we get distracted. Well, not distracted. We're so focused on our product and our clients and on business, and sometimes the financials are put aside, and that's our accountant's job or our CFO job to do. But as a founder CEO, you need to know your numbers. You need to take some time to go through the P&L. I think at that stage, really the P&L is more important than your balance sheet. They're both important, but the P&L is what you got to focus on. Make sure you know how to manage your cash, and be able to communicate your financial health to your investors on a monthly basis. One thing we did, which is interesting from an investor's perspective, is to help entrepreneurs. And this is a great thing Mark did for the Shark Tank companies, is he offered free accounting services or bookkeeping services. And that helped the entrepreneurs at an early stage, because it's one area that was challenging for them, and they could trust that the investor was providing value, and it allowed the investors to get the transparency and allow them to get the frequency of the updates. And what would happen is, after a year of free bookkeeping, that responsibility is handed back to the founder CEO, and it's up to the CEO to find another bookkeeper, or maybe one that we recommended, and continue on the financial reporting. And typically what we've seen is entrepreneurs who, after that free year and a half, if they no longer are creating that same financial reporting and transparency, then as an investor, kind of that gives you an indicator that maybe this is not a CEO founder that you should be investing more time or money as they continue to grow. And most likely, if they can't figure that part out, they're probably messing up some other areas of the business as well.
Yes, that's a good insight. And I always like to tell our portfolio companies as well that you're taking investment money from the investors, but not every dollar is the same. That some investors, they'll write you a check and they're not adding other value, but many of them want to be engaged. And the more that you can keep giving them information, giving them reports, and telling them ahead of time, this is what you're expecting that's going to come up, and are you hitting that expectation? Sometimes you exceed expectations. Sometimes there's a shortfall that might not be your fault, but what's going on in the market. But investors are more open, more willing to engage if you keep them in the loop and then show that transparency, show that you really want to do this, you really want to make this work. And entrepreneurship is hard, but you don't have to do it alone. And by having a strong investor backing, it goes a long way, not only from a capital balance sheet standpoint, but also what other expertise, what other network that they can add. And sometimes it's not just, oh, can you introduce me some, but if you keep them in the loop, then over time, they'll know more about your business. They know, oh, maybe you should think about this, think about that. So I think that's good. I have a question that came from, this one's from an entrepreneur. So how do early stage startups with limited resources, how do they reach out to family offices in order to get investments?
Yeah, it's not easy because a lot of family offices are not listed. If you Google Dallas family office, let's say, you will see a few of them, but that's just probably less than 10%. The family office network is a very close community, and in Dallas, there are a lot of family offices. The thing is, different family offices have different investment strategies. There's a saying that says, if you know one family office, you know one family office. It's not like you can't categorize them like you categorize private equity groups or VCs. The theme is different. Each family has their own priorities, and they're a different size. Some have larger teams, some have maybe one CIO. Some work with a multifamily office, a group like ours. So some invest in early stage and some don't. And there is no website or I think there's some maybe family office exchanges where you can buy a list, but it's still not that accurate where it tells you, these are the ones that you can sort through, just like, there's a pitch book or a Crunchbase where you can go in and get a list. So it is the best way to approach family offices, I think. Say if you're in Dallas, one is to keep on your radar events like these, where and other ones where you will have access to a family office principal or a professional that's talking about a certain subject. And then learn a little bit more about what they do, their investments profile, portfolio, and then try to connect via that specific event, if possible, or connect with them directly via LinkedIn. And you reference that event as a way to just start the conversation versus just going on LinkedIn, searching for family office, and just reaching out just with a cold request. So always be prepared. Like I said, you got to do your research and try to get as much as possible information on what the company has, what that family office already has invested in, and if you can find that information, and identify synergies and make sure that you fit their profile. The other thing is, well, there's not a lot of in-person events right now, but similar events to this one, I would say, are accelerator programs, any type of event that is in some way an ecosystem for investors and entrepreneurs. You might see some family office professionals there as well. And those are great because if they're attending an accelerator event or an event that connects, that is actually showcasing a lot of early stage or Series A entrepreneurs, at least you know that that family office has interest in that stage. So it'll be an easier conversation. What you need to find out is what sector and industry they like to participate in. But it's still not as easy as reaching out to like VCs.
Yes, family offices, some of them, they're more active in going out to events and all that, but not all of them are. But a lot of times with just have to go out there, and you never know who you're going to run into, or sometimes somebody knows somebody they can make an introduction. But yeah, we have a lot of questions from the audience. We're going to have to wrap up in a few minutes. We won't be able to cover all, but it seems like we have audience from all over the world. We just have one attendee all the way from Singapore. So it's good that we have in the age of digital now, it's all global, and sometimes we add value to different parts of the world. And I always tell entrepreneurs, you got to think global, not only build something that works for your market, but hey, if it works well, then it should be scalable worldwide. And that's where finding the right investor, finding the right partners can also help on that standpoint. So just to wrap up as a takeaway. So as a family office, let's say, attend this webinar, you heard a couple of other talks, some other families invest, do well. Where do you start? How should they start? Should they reach out to Legacy Night to sign up to get more involved? What's the best way?
For entrepreneurs?
For family offices that wants to start investing in early stage tech.
Yes. For family offices that want to invest in early stage tech, I think there are several, like the most obvious ways to do it is to find some of the top tier VCs in the sector that they're interested in, like a Tech Wildcatters or in Dallas, or let's say, and then the recent Horowitz in Silicon Valley. Now, not all of them you will have access to, but family offices typically make bigger checks than your average investor. So they will definitely meet the minimums that some of those larger VCs will require. But the best way to start is, I would say, start local. So if in my Dallas family, I'd reach out to Tech Wildcatters and understand what's the landscape within Dallas, because most likely I'd be interested in supporting Dallas entrepreneurs. And having kind of an expert on the ground who's been doing it for a while advise me and guide me on, what's missing in the ecosystem. How can I support the Dallas ecosystem of entrepreneurs, and at least start initiating conversations with some of the entrepreneurs that, let's say, are within Tech Wildcatters or another program similar to yours, and understanding, just having conversations. It's not, if this is my first time going to this space, I'm not going to invest in the first company that I'll look at. I need to learn more about the ecosystem, the different businesses, and most likely I'd be co-investing with someone else. So family offices collaborate a lot between each other. So if I have a family office that is investing in an early stage company, and I know that they've done their diligence because this is their area of expertise, and they're asking for me to participate and co-invest, I'm more likely to do it as a family. And from that investment, I'll be learning about what's the process and investing at that stage, the engagement with the founders and the reporting that's so important we talked about, follow-ons, and I'll feel more comfortable in doing the next investment direct versus a co-investment. And maybe when I do a direct investment, I'm going to talk to another family office and have them co-invest with me as well. But typically, like I said, I mean, it's all about the strategy and the theme and the focus of that family office, because they're called family offices because they have a lot of wealth as a family that's either multi-generational or it's a more recent exit that created a liquidation event for the individual or family, and now they have a portfolio and a strategy to invest. So like I said, you have families that invest direct, and you have families that go through the top tier funds that invest in early stage. So it depends.
Yes, sounds good. So we're right on time. So thank you very much for Abe Minkara joining us today from Legacy Night. And as always, we want to be a resource to whether it be family offices, investors want to invest in tech, and also for entrepreneurs as well, that hey, you have a good idea, a good product, something you want to do, then we have our TW Training Camp Accelerator program that we run cohort-based, milestone-based program, and also even outside of the cohort. And if there's anything that we can do to be a resource, feel free to reach out to us at Tech Wildcatters. And I'm sure the same for Legacy Night as well. All right,
Thanks,
thank you everybody, and we'll keep you posted. Sign up, we're on our newsletter. We'll keep you posted on our next webinars. And if you have any comment, feedback, or any topics that you want to hear about, just reach out to us and we'll try to find the expert speaker that we can cover those topics. All right, thank you everybody. Stay safe and let's keep pursuing our entrepreneurship journey.